Hey guys, what's up? I'm Erin and welcome back to the channel. Imagine saving for decades, getting to retirement and then restricting your spending, and then only to realize that you could have spent more freely in retirement without risking running out of money. That's exactly what Bill Bengen, the creator of the famous 4% rule, is now saying. It turns out we've been playing it a little bit too safe. Instead of withdrawing just 4%, most retirees can actually withdraw 4.7%, giving them a greater income in retirement without increasing their risk. Today, we're diving into why this shift matters, as well as the 8 key factors you need to consider before making any changes to your retirement plan. Let's dive in. Bengen recently updated his rule, saying 4% might actually be too conservative for most retirees. Instead, he says 4.7 might be a more realistic number for most retirees during that first year, and then you get to adjust up annually for inflation after that. And that's great news for retirees because that means they get to spend more with confidence. For example, if you start retirement with a $1 million portfolio using a 4% withdrawal rate, that means you would take out $40,000 per year. But with a 4.7 withdrawal rate, you'd get $47,000 a year instead. And since withdrawals adjust for inflation, here's what those withdrawals would look like over the first 3 years, assuming a 3% inflation rate. That gives you a 17.5% increase in annual spending power. Over the course of a 30-year retirement, using our numbers from our previous example, that would allow you to spend over $300,000 more. And I don't know about you, but to me, that makes it sound like you'd have a little bit more fun in retirement. At first glance, it might seem that there's nothing more than just this 8.7% figure. That's the whole story. But Bengen says there's more to it than that. He says there's 8 factors you have to consider when looking at this safe rate of withdrawal. So let's break them down. First and foremost, Bengen says you need to think about how long your retirement is going to be. His model assumes a 30-year retirement, but if you expect to live longer, you need to plan accordingly. He also says it's best to build in a 10-year buffer on top of whatever type of retirement you're planning, just to play it safe. So if you're planning on retiring at 60 and living until the age of 90, you might want to plan for a 40-year retirement rather than those 30 years, because the last thing you want to do is get to the age of 90, have good health on your side, and then run out of money and be forced back into the workforce at that time. How long of a retirement you're planning for absolutely impacts your withdrawal rate. If you're planning on having a long retirement, something like 40 years, you're going to want to dial back your rate of withdrawal. Maybe you use something like 4%. Maybe it's something like 3.5%. If you're going to have a shorter time in retirement, you can dial it up. Maybe you use 5%. Maybe you use 6%. It's all about balancing your risk and making sure that your money lasts as long as you do. Another factor to consider is whether you want to leave an inheritance for your loved ones. This one actually surprised me a little bit. Bengen says that his model is based on 30 years of spending down your wealth. So at the end of those 30 years, your portfolio balance is near zero. So it's not designed to leave anything behind to your heirs. If that is something you want to do, he says you have to adjust your withdrawal rate accordingly. For example, with a $2 million portfolio using the 4.7 rule, it would give you $94,000 per year to spend. But if your goal is to leave, say, $500,000 behind, you might instead want to lower your withdrawal rate to 3.5%, taking out only, say, $70,000 per year. That being said, here's something that's really interesting. 90 to 95% of people who actually follow the 4% rule in the real world, 30 years into their retirement, they actually end up with a portfolio that is larger than what they truly started with. So even if this model says that it's meant to be a spend down method, that's not actually what we see when we look at the real world data. So if we were to use our previous example, if someone retires with a portfolio of $2 million, there is a 90 to a 95% chance that in 30 years' time, they will have more than $2 million in investments still if they follow this rule. So before you go adjusting down your rate of withdrawal, it's worth considering the real world data, because the vast majority of retirees who actually do follow this rule still have plenty left over by the time they hit the end of their retirement. It is worth considering what your goals are. Do you want to spend more now or leave more as a legacy? But it is worth also considering what we see in the real world. One thing Bengen's model doesn't factor in is taxes on withdrawals. So while you might be planning on a withdrawal of 4% or 4.7%, how much you actually get to keep in terms of spending power, well, that's going to depend on what type of account is coming from. If it's coming from, say, a traditional 401k or a traditional IRA, those withdrawals are going to be subject to ordinary income tax. So a big chunk is going to go to the IRS. If it's coming from a traditional brokerage account, well, then you might owe capital gains taxes on that. If it's coming from a Roth account, well, then you get to keep 100% of that withdrawal and spend it as you so choose. So if you want to maximize your spending power while strictly adhering to one of these withdrawal rates, it might make more sense to prioritize your Roth account, because a $50,000 withdrawal from a traditional account is very different than a $50,000 withdrawal from a Roth account. One of the biggest misconceptions about the 4.7% rule is that you can apply it to any portfolio. But that's not the case. Bengen's research is based on a specific portfolio mix, and straying too far from that mix could mean that you have to lower the safe rate of withdrawal. Here's what Bengen recommends. He says you have to have at least 47% to 75% in stocks for long-term growth. The rest of it can go into bonds and cash for stability. His optimal portfolio is 47% stocks, 33% bonds, and 20% REITs, or real estate investment trusts, which he has found to best support this 4.7% withdrawal rate. It's also worth noting that Bengen's research includes 7 different asset classes, adding even more diversification. But does that mean that you need to copy his exact portfolio? Not necessarily. Some people love this balanced approach, while other people, like me, prefer a simpler approach. I'm a huge fan of the total stock market index. It gives me really broad exposure in one place. But ultimately, at the end of the day, you have to build a portfolio that fits you, your needs, your goals, and your lifestyle. So why does Bengen include so many asset classes? Well, stocks, these drive your growth and they act as a hedge against inflation. Bonds, he says, provide stability and income. And REITs, well, he says those are inflation protection and added income streams. The main takeaway is that your withdrawal rate depends on your portfolio mix, so make sure your investments support the strategy that you're using. Bengen emphasizes the importance of rebalancing your portfolio annually to keep it aligned with your target allocation. Let's say you start retirement with the optimized mix according to Bengen: 47% stocks, 33% bonds, and 20% REITs. Now, if the stock market has a great year and your stocks, say, grow to 60% of your portfolio, while bonds drop to 20%, well, that sounds great, but then what if there's a market downturn and suddenly your portfolio has more risk than you're truly comfortable with? So when you rebalance, you get yourself back to your targeted risk exposure and you help to preserve your portfolio for the long term and preserve your withdrawal abilities. Interestingly enough, Bengen also suggests that over time, you actually may want to increase your exposure to stocks rather than reduce it, pointing out that it is really stocks that are the driver of a portfolio's growth. So if you want to maintain your ability to sustain these long-term withdrawals, you want to make sure that you still have adequate exposure to equities. If you get too heavily weighted towards cash or bonds, you would have to lower your withdrawal or you would not be able to sustain it over time. The challenge is balancing growth with stability. Too much in stocks could be risky, but too little could cause you to run out of money faster. The bottom line is rebalancing is key to managing your risk and key to making sure that you can sustain your withdrawals over the course of your retirement. Bengen's model is built on the assumption that retirees are investing in low-cost index funds. And that's a big reason why the 4.7 withdrawal rate works. If you're an indexed investor, you get to benefit from market returns at rock bottom fees. This supports a higher rate of withdrawal. However, if you're using actively managed funds, well, things change a little bit. You're paying higher fees, so those are going to eat into your returns, and you're only going to be able to take more modest withdrawals. So really, it's a lose-lose situation. You're paying more in fees, and you get to spend less in retirement. And for me, this is just yet another reason why low-cost index funds or ETFs are just the way to go, because you get to keep more of your money working for you and you get to have a higher long-term sustainable withdrawal rate. One of the big questions retirees face is how to time their withdrawals. Should you take out this money monthly or maybe just do a lump sum once during the year? Well, Bengen says it's best to spread it out throughout the course of the entire year. Kind of treat it like a paycheck. Maybe do one withdrawal a month rather than one lump sum. For example, if you have a $1 million portfolio and are withdrawing $47,000 per year, instead of taking it out all at once, you'd withdraw about $3,917 per month. If you take one large lump sum, you're more exposed to market risk. What if you take it out when the market is down? Well, then you end up locking in your losses. Alternatively, if you take smaller withdrawals throughout the course of the entire year, you sort of smooth out those market fluctuations and you actually mitigate your risk and you make your withdrawals more sustainable over time. One of the biggest things Bengen emphasizes is that retirement planning isn't static. Over a 30-year retirement, there will be ups and downs, and the key to long-term success is staying flexible and adjusting as needed. The 4% rule, or now the 4.7% rule, is a great starting point, but it's important to keep in mind that it's only one factor. And also keep in mind that your portfolio is more than just numbers on a screen. It represents a lifetime of freedom and hopefully financial security for yourself. That is why it's so important to understand your withdrawal strategy and remain flexible in the strategy throughout the course of your entire retirement. So what are your plans? Are you going to follow something like the 4% rule, or are you going to follow something like the 4.7% rule, or do you have a different strategy in mind? Leave your thoughts in a comment down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. I cannot breathe today. Let's get the microphone out of the way. Hey guys, what's up? Oh, if this is any indicator, it's gonna be a rough day. I just cannot breathe. Planning on happening. I am dying over here. Or could cause you to have to not I don't know how to do this. It's weird if like every time I cut back from the camera I'm like I can't be like that aggressively smiley. That was my old email address when I first started on the scene in the 90s. It was like smiley443. That was me. 443, I assume there were 442 people who came before me with that screen name, so. Oh, the good old AOL days. Oh my God, I can't breathe.